morning, Rotarians and guests.
Good morning.
Ron Strobel, Sergeant at Arms, having trouble this morning keeping arms. Invocation this morning is by Phil Tobin.
Morning, everybody.
Heavenly Father, we acknowledge your being and your expectation of us as Rotarians. That we be of service to others, let us renew our pledge to fulfill that expectation, just as the return of spring renews growth in this world around us. With a new commitment to help others, with the power and influence and wealth we have, let us always remember that these are blessings from you, and that charity and love are the greatest virtues of all. Bless this food to our liking and us to your service. Amen.
Amen.
Thanks, Ron.
Thank you, Phil. To lead us in the pledge and four-way test this morning, Ed Sogan. I pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Four-way test. First,
Is it the truth?
second,
Is it fair to all concerned?
third,
Will it build goodwill and better friendships?
fourth.
Will it be beneficial to all concerned?
Thank you, Ed. And to lead us in song, Dick Pearsall.
I've been watching the TV, and the baseball people are out. I thought, gee, it's a good time we ought to practice that thing. The weather didn't quite go along with me, but we don't have anybody to flash the words out anyway, so we're going to sing "Take Me Out to the Ball Game."
All right.
Take me out to the ball game. Take me out to the park. Buy me some peanuts and cracker jacks. I don't care if I ever get back. So let's root for the Indians. It's a shame. For it's 1, 2, 3 strikes, you're out of the old ball game. Did well.
Good job. It takes us for one guy to say something different, and then the whole song falls apart.
This is the year.
Our president is back, Allison Feaster.
Hey! Thank you. It's nice to be back with no snow. So, Chris, would you like to introduce our guest today?
Good morning, Rotarians. It's nice to see that some of us stayed in town for spring break. I would like to announce our guest today, who also happens to be our speaker. Joining us today is Michael McCleary. He is the Chief Investment Officer at Velmark Securities. If you'd like to stand so we could give you a nice greeting. Thank you for joining us.
I received a nice note from one of our service learning students, Noah Stupica, and I'm going to read it. It's very short. Dear Rotary members, thank you for giving me the opportunity to share my experiences with you. I am very passionate about the service learning class at Hudson High School, and I would like to thank you for supporting the class in our community. That's nice. Ron, you want to come back up and talk about the gala and Memorial Day Parade?
Sorry, this year we don't have all the slides and everything. In the past we've used race cars, we've used horses and everything else to show which teams are leading and which ones aren't, but we just don't have all that ability this year, I guess. Anyway, there are 2 weeks left. That's all. It's been a short season this year, with the gala being moved up to May 8th. So 2 weeks left to get our gifts in. At the end of last week, just looking at the data sheets, there probably wasn't, I don't know, 10, Evan, 5,000, 10,000?
I think it's probably between that.
Okay.
With today, it'll probably be 10 to 15 probably.
Okay, 10 or 15. And as you'll remember, we need somewhere between $60,000 and $70,000 in order to hit our goal of 40,000 net. So there's a long ways to go, as there always is with 2 weeks remaining. But that means there's a lot of work for the people doing the gift intake and database and everything. That so the sooner you get them in, the better. So it'd be nice if you could get a lot of them in next week, so that the final week there isn't such a large number and such a crunch. So 2 weeks, and there's 1 month to get the tickets sold. And how are the ticket sales going, Ron? Slow, but steady. Okay, good. So there's a month to get your tickets sold. If anyone needs invitations that they would like to send out to their friends, family, etc., I have them. You can see me after the meeting today. Gail will have them in her office, and she'll have them here next week. I'll be missing again. So if anybody needs them, we've got them. I find them very useful to send out to people that I just don't see every day, but I know they're going to come. So that's the gala. We've got a lot of work to do, short period of time to do it, but we've done it every other year, so I'm sure we can do it again. Memorial Day Parade. For some reason or another, I have to speak about that, which indicates that we need volunteers. We really need a volunteer to take over the Memorial Day Parade. I think Tom Tobin and I have been doing it by default for the past several years. So if anybody would be interested in being in charge of that, please step forward. Also, and we'll talk about this some more as we get closer, because it is 2 months away, we're going to need 3 people, 1 to carry the flag and 2 to carry the banner and walk. And then we need to decide what vehicles we're going to have in the parade. See Allison or myself over the next week or 2 so that we can get our application sent in. We need to send in an application telling them how many vehicles and walkers and so forth we're going to have in the parade. So either Allison or myself over the next 2 weeks. Thank you.
It's nice to even think about May and walking in a parade. Next we have Craig Tallman, who's going to give us the update on our grants and the foundation.
Good morning, Rotarians. Good morning, Craig. Just a couple of notes on where we're at. We're actually coming very close to completing our fiscal year here. We have 1 more meeting set up here in May, and that'll be the conclusion of the fiscal year we're in right now, and we'll start all over in July. Where we're at, on the budget side, we actually have 1 budgeted grant that has not been submitted for yet. And that's the Hudson Bandstand. So if anybody's familiar with it, that organization, you know somebody, please mention it to them. We do have monies budgeted for that. Most recently, we did receive a request from the Hudson Players. The committee approved that. It's going to be submitted to the board shortly here at the next meeting with the prior approval of the foundation board, so that check can be authorized quickly. If the club board does agree to pursue that as well. A couple other notes, you might be missing Duncan Tanner's weekly updates and so forth. Duncan and I have exchanged emails back and forth from his new residence in Florida. He's completing the draft of the assessment audit that he was doing previously to kind of give us a better idea of how all of us as a group feel about our different fundraising activities and how diversified that has become over the years, and maybe some better solutions in terms of how we can do that. So more to come. I really don't have any insight other than that at this point. Another project that Roseanne's working on, hopefully we'll get it done by the end of the year. With Alice being back, we can get our notes matched up on it, but we're doing a modification and an update of our code of regulations so that it reflects probably more contemporary and current things that we're doing. It's somewhat dated and it really needs to be brought up to date. A couple things outstanding. We just received a grant request from the high school to help support the the musical Shrek. And so the committee is going to be reviewing that here shortly and presenting their thoughts on that to the club board. The request is $4,000, and we know that play itself is an extraordinary production by the high school. And something like this, while it's not budgeted, would be considered to be taken from our miscellaneous funds, which we do have sufficient funds to cover at least part of that request this year. Also pleased to announce this morning, Den presented us with a check from the Burton Morgan Foundation. It is the completion of a grant we were awarded back in December due to Den's efforts and so forth, and we appreciate that, Den. Thank you very much for that. And that $1,000 grant that we received will go toward our scholarship funds for this year. So that's a big boost for us in that particular category. Financially, we're sound. I would tell you that since October, our operating fund has increased by 12%, with a balance as of about 2 weeks ago. We're at $51,788. Our goal every year is to come in around 50,000. We feel 50,000 is what we need to operate the foundation across the year. Our endowment fund, or our permanent fund, rests at about $135,000 as of this morning, and so that continues to progress, but fluctuates with the market, as I'm sure you follow, with the consistency that we all do. Again, the strategy there is more of a balanced strategy between equities and bonds, and Art is our fund manager, and I believe is doing a very good job staying consistent with market trends. So that's all I had to report this morning. Any questions? Okay, thank you.
Thanks, Craig. Great job. Now we're ready for our featured speaker. And Jim?
Well, since it's do-it-yourself.
Jim Ahern is our speaker chair for the month.
Hey, we're going on a trip. Okay.
Yeah, that would be a good idea. They're going to make you stand behind the mic for a little while, Mike, after I'm done. I got it. But there's
He's got a remote.
camera.
He's wired.
Is he going to follow him with the camera?
Oh, that's gonna be jerking all around.
All right, we're good out.
What do you want on? You want on you now?
No.
He's gonna yell at you.
You got him in a bad mood. You got him in a bad mood. I'm very happy to have Mike McCleary here today, and let me tell you a little bit about Mike. He's Chief Investment Officer for Valmark Advisor, and has been with Valmark organization and led the TOPS program with Valmark since 2003. For those of you who don't know what Valmark is a leading national independent wealth management for 50 years, and they do business in over 30 states. Mike is directly responsible for the investment programs for Valmark, and he also helps to oversee all broker-dealer investment products. Mike's main focus is leading the portfolio management team for the optimized portfolio system that he may refer to a few times, called TOPS. It's one of the nation's largest and longest running, most successful exchange-traded funds. In ETF management programs with over $5 billion in assets. The TOPS is available primarily through separately managed accounts, collective investment funds, and variable insurance funds. Michael is a Bachelor of Science in Administration. He got a magna cum laude along with the rest of us in financial services and an MBA in financial management from Akron. He's recognized as one of the nation's leading experts on ETFs. He's one of 3 individuals nationally selected to be the first class of the ETFs Advisor Hall of Fame by Research Magazine in 2007. In 2012, he was named one of 10 rising stars by ETF Report. In 2014, he was named to one of 10 all-stars in the ETF industry. And he's also collaborated with Wall Street Journal, Kiplinger's Financial Advisor, and Research Magazine on ETF-related topics. So, Mike, with all that, it's all yours.
You guys are on the record bio, that's what happens, I guess. Get a lot of complimentary stuff on there. But I tried to get some energy today. I came back late from a business trip last night, and then my son got a little cold, so he decided every hour to wake us up, and somebody to run up and wipe his nose. He's 3 years old. So I kind of got about 3 hours of sleep last night, spread out over a few hours. So I'll try to get some energy going. Everybody hear me okay? I'm getting a little bit of feedback. Okay, this side here. I was working, and I'll be very clear with you. Jim asked me to speak, and I'm doing this really just to share my ideas. I appreciate everybody kind of coming here. I work primarily at a home office. I run portfolios. I tell people that I get my tan in the summer usually from my computer screen. I'm doing a lot of internal office stuff. So I'm not here to I don't really work with individual clients directly, so I'm not here to talk about that. I just want to help to educate you, give you some ideas. Hopefully we'll spend some time together that's useful for you this morning. Because I'm in the business, I had to submit my presentation to our compliance folks. And our attorney who works for me said, the Rotarians, this is great. She's like, give you a quick background. Her family, her father was in the South Vietnamese Army. And he immigrated here and got into business and so forth. And Gigi is her name. And Gigi's a tremendous hard worker, and it's a great asset for us. But she got a Rotarian scholarship in college. That's one of the reasons why she was able to have the success that she's had. So it was a good kind of background for me, and she was happy to hear that I was spending my time this morning speaking with you. And I'm sure you guys get a lot of opportunities to hear those stories, but this is, I think that's 20-something years ago for her, and she still remembers that scholarship, which I don't know if it was $500 or $1,000 or whatever, but that scholarship that she received. So people do remember those for a lifetime. And this is, as Jim had mentioned, probably the first time I've sung before 8 in the morning in a long time. so I'm getting indoctrinated, I guess, a little bit into your philosophy. So it's good to see the energy. As Jim mentioned, I've been fortunate kind of 3 times in my life. One time to be kind of at the head of, how many of you have heard of exchange traded funds, ETFs? If I would have asked that question 10 years ago, nobody, maybe 2 or 3 people would have raised their hand. For the first years of my career, I ended up discerning between exchange traded funds and electronic funds transfer. People are kind of familiar with EFT because of a bank transaction. And I don't know how many times that people said, oh yeah, I know EFTs, and it was a difficult thing for people to look at. But because we started so early and we've been able to have some success, we are the 3rd largest in the country at what we do, even though we're located here just south of Cleveland. So there's a lot of great businesses. Just even if you hear each of your individual stories here in Northeastern Ohio, they're doing good things, and you may not always notice them. But we are a business here in Northeastern Ohio. When I started 12 years ago, we had about 35 people. Now we have about 120 in our office in Fairlawn. So there's a lot of great stories that are happening, and I'm a big fan. As you heard, I came from Akron, and I grew up in the Akron area, and a fan of Northeastern Ohio. Okay, sorry about that. I want to talk a little bit about 2014, and just give you some ideas of what I think is kind of going on coming from 2014 into 2015 in the markets. 2014 was a really unique year. I've been managing our portfolios for almost 13 years, and I said this was probably the most difficult year to explain to clients really what's going on in the market. Because first of all, how many of you opened your statement at the end of the year and said, man, I thought U.S. markets were doing great. Why did I not get over 10% return last year? I think a lot of people did that, and that's the natural reaction. Because what happened last year was that the S&P 500, large cap U.S. stocks, did tremendously better than about everything else. And because that's the gauge a lot of people look at is the S&P 500, people started questioning and saying, why did my portfolio not get 14% last year when the S&P 500 was up 14%? Well, what I'll show you is that, most other things, like I said, did trail that number. So it was a very unique year. And the hardest part is, you open that statement and you say, wow, why didn't I get 14%? Something's wrong. And then your first reaction is, what's the description? What's the answer for this? Well, the hard part of it is the answer is not an easy one. A big part of the reason why you didn't get 14% was that we had one of the biggest swings in currencies last year that we've had in a long time. And you talk about an esoteric concept that, is difficult for most people. They're not dealing with on a day-to-day basis is currency transactions. And so you have something that's uncomfortable. You've underperformed the S&P 500. 95 or 99.9% of people did. And then you say, something's wrong here. What's the answer? Well, the answer is something somewhat difficult to understand as well. So I'm going to try to give you kind of easiest description I have of what happened in the currency markets last year. And then on top of that, we had significant swings in oil and interest rates. Now, for most folks, that just means lower prices at the gas tank. But if you hold them in an investment portfolio, anything you have tied to oil went down in value. And we had a significant drop in the price of oil last year. And then the last component of it is interest rates. How many people in the room thought interest rates were going to go up last year, if you had an opinion of it? I think most people did. And actually, the Wall Street Journal ran a survey of top economists. And out of 45 economists they surveyed, 44 said that interest rates were going to go up last year. One of them said they were going to stay the same. None of the 45 said they were going to go down. What happened last year? Interest rates went down by almost 1% on the 10-year Treasury. So, much to the surprise of most folks, what happened in the interest rate market. So here's a quick example of different things. Try not to get too deep into some of my slides. I'll just point out specific items. But you see large cap U.S. stocks finished last year up about 14%. International stocks were down about 5%. Almost a 20% difference in return between U.S. stocks, U.S. large cap stocks, and international stocks. Okay? And a big reason for that is this. What this chart looks at is the return in the local currency versus the return in the US dollar. So let me tell you what this means. If you invested in the Japanese stock market last year, and you're a Japanese resident, you live in Tokyo, you invested in yen, your return last year was 9.48%. If you invested and you live in Manhattan, and you invested in US dollars in the Japanese stock market, your return for the year was negative 4%. Nearly a 14% difference just based off currency movements last year. The dollar strengthened significantly. This was not just the yen. In emerging markets, the difference almost 8%. You can see about a 10% difference with the euro, with the European markets. So effectively, any investment that you had outside of the US last year took a haircut of 10 to 14% just based off of currency movements. Okay? So it was a really unique year. Now, one thing you may be asking is, what can I do to protect myself, and why do people see that coming to some degree? Well, currencies, it's NCAA basketball time, so it's easy to kind of look at this, but I write a lot of articles. I wrote an article last month, and I said, predicting short-term currency movements is infinitely more difficult than filling out a perfect NCAA men's basketball bracket. So we know how difficult it is to fill an NCAA men's basketball bracket perfectly. I think we've all seen the stats over the weekend. You're not going to have a successful investing career if your ideal is to pick currency market swings. Picking interest rates is difficult enough, but currency swings is infinitely more difficult. And so over time, currencies tend to cycle. And the dollar will appreciate. Usually it's around a 7-year cycle, and then the euro will appreciate, and it'll come back and forth. But over time, you tend to normalize. So you think about it from an economic perspective. Can the European currency, the euro, continue to go down 14% versus the dollar forever? Can that happen? It's impossible. It's physically impossible to happen. I mean, you would have a situation where euro would be worth zero, and they'd have no value. It's impossible to happen. So economically, it has to cycle and it has to come back. Now, one of the things you may be asking yourself too is saying, it's hard to look at the end of the year and say, I felt U.S. stocks were going to do well. I should have put 100% of my money there. Well, there was a nice article that came out I think 2 months ago that said, if you got better than 5% return in your portfolio last year, you should fire your financial advisor. You took on too much risk. And I thought it was a little extreme, but it kind of it's meant to prove a point that risk matters. And looking at it, and most folks in the room, including myself, should not have 100% of your money in the S&P 500. So that was really an unattainable result for most folks. Because in investing, it's difficult to look, and this study shows this. We call this the smartest man in the world. And the smartest person, what you do is you take the number one asset class, okay, the number one asset class, and you pick it before it does well. So if you do that over a period of years, and this study runs for about 11 years, your return is 25.9%. Okay, that's the best you could have possibly done. Now, as we know, that is impossible to actually do. So that's an unattainable result. But during this 11-year period, that's the best you could have possibly done, 25% a year return. Now, I call this the brother-in-law. The brother-in-law is the one that goes to the New Year's Eve party, talks to the smartest man in the world, and says, the smartest man in the world says, I had all my money in large cap U.S. stocks last year. Brother-in-law just understands that and puts all his money in U.S. large cap stocks. So if you invest in the asset classes that did well last year, your annualized return is 3%. That's the worst thing you can do. The worst thing you can do is put all your money in what did best last year. Now, how many people, I mean, intuitively, that's the human nature thing. That's what everybody wants to do. Put your money in what has done well recently. You know, and I think somebody mentioned earlier about your portfolio, just staying disciplined, you know, and doing a good balanced approach. Putting your money in simply the S&P 500, you can see the results there. And a diversified portfolio does very well. And also, what this means is standard deviation. This is a measure of risk. The higher the number, the higher the risk. And you can see that this portfolio, a diversified portfolio, same return, much less risk. So just a reminder on why you want to have a balanced portfolio. Now, these are some of the emotions that you go through as you're going through these things. And one thing we found is we've done some different studies on investor behavior, and psychological factors tend to account for about 45 to 55% of the result of investments that folks have. So that human nature, that idea that, hey, you know, I don't like what happened last month or last week, and going in and changing, you know, based off an emotion you have, that's one of the reasons why, on average, most investors underperform the indexes, because of the emotions and the things that they're going through and the changes they make in their portfolio. Okay, it makes significant impact on results. Another part that we tend to see is this. I'll just explain what this means because it's a little hard to look at it. But the gray is the S&P 500. Okay, and then the mutual. This is funds flows into mutual funds. What you tend to see is as the market goes up, people start putting their money in. Okay, it trails a little bit, and then just as the market goes out, people start pulling their money out. The gray line versus the orangish yellow, or I guess yellowish is what I'm showing here, golden. And you can see that if you look at this trend, you were studying this a little bit, you can see here's a situation that is really telling. Markets continue to go up, but people are pulling their money out. And that's an emotional type of thing that happened. So investors tend to be wrong. You know, that's why institutional investors tend to do well. You know, that's why people like me have a job, because what I try to do is take emotion out of investing a portfolio. And we manage a lot of money. My primary clients we manage money for 21 different insurance companies. So, you know, as I'm working with an insurance company and I'm managing money for an insurance company, you know, I'm looking at that, doing the best clinical job I can in managing that portfolio. They're not going to call me, an insurance company's not going to call me next week and say, you know, we read the Wall Street Journal this morning, we just don't feel like today we should be in the market. That's not in what I do on a day-to-day basis. And over time, having that discipline is going to be the best way statistically to improve your results. Now, let's look at that. We had the S&P 500 do very well last year. It creates a little bit of a perfect storm too, because you know we all stood up here and did the Pledge of Allegiance. You know, obviously I'm an American. I'm a huge patriot. I love this country, and it just seems right. We're smarter. We're doing things better. We did better than everybody last year. I should have had all my money there. Just it just kind of feeds to our human nature and our emotion of, you know, let's put extra money in large cap stocks. I mean, the most comfortable thing for me did the best. You know, let's do that. That's a great thing for me to do. Well, as you look at it right now, we have, if you look at our portfolios, any one of our portfolios, you look at our stock allocations, we had the most money in all of our in U.S. large cap stocks last year. So look at all our poker chips. We put our most chips on the 1-to-1. I mean, we do feel like large cap U.S. stocks, you know, is a good place to go. Growth rates are good and so forth. However, you need to diversify. You need to have that discipline. So I'm going to say a few things about why maybe you don't want to put 100% of your money in large cap U.S. stocks, but speaking to a group I recognize like myself, remember, I'm not saying this, I'm not trying to be anti-American from an investment perspective. We still have the most money on the U.S. large cap stocks. But here's the reason why you might not put 100% of your money there. First of all, is we look at valuations, okay? I'll explain what this means. We take a look at how stocks are priced versus how they've been priced for the last 20 years. Okay, let's look at this. If you look at S&P 500 growth, this is effectively the S&P 500 growth stocks. They are more expensive now than they've been 72% of the time in the last 20 years. That's where the numbers go. So if you take 72 every month, you take the valuations every month for the last 20 years, and you look at where we're at right now, we're more expensive now than we've been 72% of the time in the last 20 years. Okay. You look at mid-cap and small-cap stocks, you're nearly 80%. So you're more expensive now than you've been 80% of the time in the last 20 years. Okay? Now, international stocks are about 36th and 38th percentile. So there's three ways you make money in investment or in a stock, okay, or a stock portfolio, whatever you look at. The first one is buying on sale. So if the average price is 16 and you buy it at 14, you have an expected return, positive return, based off the fact that you're buying it historically on sale. That's one of the ways in which you make money in a stock. Okay. The next way is underlying growth. That's what we're all familiar with. Okay, the economy did well, the company did well, earnings did good, so I made money. The third piece is dividends. So let's look at those three things for the S&P 500. I'll start with the second and third, and then I'll wrap it up with valuations. The growth rates right now in earnings are about 2.5%, 3% in the S&P 500. Okay, so that's what you can expect from growth. The dividends are 1.9%. So that gets you to a 5% expected rate of return. Okay. Now, where's the kicker on valuations? Are you buying them on sale or are you buying them under price? Are they on sale right now? Large cap US stocks? No. They're historically overpriced. So the expectation for large cap US stocks is that you're going to have actually a hit over time because eventually the price is going to regress back to, return back to normal pricing. So one thing I'll prepare you for is that, you know, looking at an investment in large cap US stocks right now, and if you're expecting a 9% annualized rate of return in the next 10 years, you know, a lot of things can happen, but the numbers aren't there to say that that's the most likely result. You know, we're in a situation where stocks right now are overvalued, so if you're buying stocks in the US, they're historically overvalued right now. Growth rates are pretty low, dividends 1.9%. Now, if I'm telling you that same story international stocks growth rates are a little bit lower, but same ballpark. Dividends are closer to 3%, high twos, so you're getting about an extra 1% in dividends, and you're buying them on sale. So you have an expected positive return just from the fact you're buying them on sale. Okay? So if you're looking at your portfolio right now and you're saying, hey, financial advisor, and I'm talking generally for financial advisors, you know, let's take all our money out of international stocks and put them into US stocks. That's probably why your financial advisor is saying, maybe that's not the best thing to do right now. So just some background on that. Now, this, I'm not going to get into this. I want to be careful of time today. But this is different ratios. What I want to show you is one thing that I'm very careful about is there's a nasty term in our industry called data mining. It's trying to find the numbers to back up what you want to say. And, you know, I give a lot of presentations. I have a lot of data. And one thing you'll find with me, I always qualifier slides to make sure one guy raises their hand and says, well, what about that time period that I can show? No, just pick that time period. But these are different valuation ratios. And what I'm showing you is every single one of these is showing we're overvalued. I didn't just pick one ratio. Every one of them is showing we're overvalued. Now, here's, again, don't get too into this slide. I'm going to tell you what the pictures mean. This is the United States, okay? The brown is the average valuation. The triangle, or excuse me, diamond is where we're at right now. So the higher means the higher value. And if the triangle is above the brown line, it means we're overvalued. The U.S. is the most expensive in the world, okay? It's the most expensive in the world. So people are paying a premium right now for U.S. stocks, and will that continue, okay? Now, what this shows, and again, just a graphical, don't get too into the numbers, these are developed countries, and these are growth rates. So the higher the bar, the higher the growth rate of the economy. These are emerging market countries. So just don't read the words. Which ones are higher? Top or the bottom? Top. So emerging market stocks are undervalued, growing at a higher rate, and dividends are actually about the same as regular national stocks, so higher than the S&P 500. So where's the higher expected return? If all three factors are higher than U.S. stocks, where's the higher expected return going forward? With emerging market stocks. Now, emerging market stocks are a different animal than U.S. blue chip stocks. You're going to get that every year? No. But over time, that's why folks might say, or financial advisor might say, hey, put a few percent in emerging market stocks. The return expectation is higher. Now, we're set up in tables here, so this is perfect, okay? What this chart shows is debt to GDP ratio. What that means is where our debt is versus the size of our economy. And if we were to set up all these tables today and group you by debt, here's who would be at our table, okay? The further to the right is the higher the debt percentage. US, Portugal, Italy, Greece, and Japan. So remember 3 or 4 years ago, people talked about the debt ceiling and all the problems. That didn't go away, it actually got a little worse. So the fact that our stock market's done well the last 2 or 3 years didn't get rid of the debt issue. We didn't inflate away our debt. We had no inflation really, so we didn't inflate away our debt. You know, that's where we would be at. You know, so you know, it kind of does. It takes a little bit of the blue chip away from blue, a little bit of the blue away from blue, or adds the blue to blue chip, I should say. But just remember that. You know, again, why you're not putting 100% of your money into U.S. large cap stocks. And the last thing I want to, or not last thing on this, the last thing on this is the bull market. Okay, this is the average degree to which a bull market occurs, and every bull market ends with what? a bear market. By definition, every single bull market ends with a bear market. That's what happens, okay? So the average, this is average growth. So the average, going back to 1946, is 178%. We're over now about 200%. So the bull market we're in right now has grown more than a typical bull market. The average length is 68 months. We're at over 70 now. So we're past the average growth and past the average length of a typical bull market. That's not alone something to make your decision on. It's just something to remember. We, by definition, should have a bear market, a decrease in assets of over 25% at some point in the next 5 years. We've had 2 bear markets every decade for the last 5, and it's been almost 7 years since the last. So, I mean, by definition, you know, as again you go back to those expected rates of return, something to prepare yourselves for. We more than likely will have a recession in the next 5 years, and more than likely we'll have a bear market in the next 5 years. Something to think about. And you're going to see, I think, as we get into the latter stages of the bull market, a little bit more volatility. What this slide shows is the lowest point the market was at in a given year, is the red line, versus where it ended up. So one of the hard parts is you can't sit there and just pull your March statement out and say, this is going to be a bad year because we're down 10%. You know, you look at this year, for example, we were at one point down 30, we finished it down 13. You know, this is just an example of volatility in the market. And what you typically see you know, towards the latter stages of a bull market is some increased volatility. You're going to see some things jump around a little more. The other thing that I think is important, sorry if I make people dizzy here, is what's going on in the interest rate market. Let me give you a quick thing that, you know, as you're looking right now, remember this as you're looking at bond holdings, okay? We are at the end, some point at the end, I mean, what's going to be the next 6 months, year, whatever, of the biggest bull market in bonds in any of our generations. You know, the last 30 years in bonds has been a tremendous investment. Because what you've seen is you've seen interest rates go down from the early 80s, you know, the 17, 18% interest rates, down to this morning, the 10-year Treasury is paying about 1.9%. Okay? And what happens with bond prices is as interest rates go down, bond prices go up. So for 30 years, bond interest rates have been going down, and your bonds have been gaining in value. You've been getting an extra kicker just from being born at the right time. The problem is my 3.5-year-old son's not going to have the same bond market experience. Okay? Because we're at the bottom, you know, in interest rate perspective, and you only have one way to go. You know? So as interest rates do increase, because they will eventually, recognize that by definition, rising interest rates will decrease the principal value in your bonds. And there's some things that you can do to protect against that, but that's a mathematical equation. You know, what happens is interest rates rise, your bond is less attractive than it was the day before because of the current interest rate on that bond. You can buy new bonds at a higher interest rate. Okay? So we're going to see, you know, the Fed talked last week. People are saying it's going to be June or September, but we will start seeing an interest rate rise. Okay, it's going to happen. And one of the reasons is that, again, I said, you know, it's been 7 years since the last recession. Longest we've gone in the last 100 years is 10 years. Sometime in the next 5 years, we're going to have a recession. How does the Fed fight a recession? By lowering interest rates, right? Well, we're at 0. So we talked about our fund earlier, you know, with the Rotary fund. Their cash is gone. I mean, they got no tools. They got no weaponry right now. So they want to raise interest rates before we get to the next recession, so they got something to do. You know, I mean, they need. I'm not saying it jokingly. I'm saying they need to do that because they do not want to enter the next recession with interest rates still at 0. That could be a difficult situation. So I just want to close with a few comments about things to think about. This is looking at different market environments and looking at sustainable withdrawal rates. Okay, so this is a 4%, 5%, 6% withdrawal rate. And this is for a typical market. So this is what to expect. Because one thing I see, I've been doing this for quite a while, and you know, folks like to look at, well, this is the income I need. Recognize when you look at the income you need versus the money that you have, you're taking risks on what percentages you're taking out of your portfolio. You know, as you can see in a typical market, a 4% rate of withdrawal is pretty sustainable. Should last you over 25 years. If you start taking a 5% or 6% rate of withdrawal, even in a normal market, on your portfolio assets, your chances of that money lasting go down. Now, the bad part is that, you know, we're in a market right now where I'm telling you that, you know, all else being equal, expected returns on bonds are not tremendously high, and at least for the next few years, expected returns on U.S. stocks are not very high. So this is looking at the 25th percentile. So this is the markets, that'll be at the 25th percentile. So a little bit worse returns. And as you can see, even a 5% rate of withdrawal, specifically a 6%, does not last as long. So just something you might want to think about with your portfolios as you go on. Another thing to think about too is I really encourage you not to market time. Market timing does not typically work. Okay, it's not typically work. Market timing is going in and trying to say, I'm out of the market, I stay out for 3 or 4 months and go back in when I feel it's the right time. What this chart shows is if you stay fully invested over, this is 1995 to 2014, and this is what your return is instead if you missed the 10 best days in the market. If you missed the 20 best days, the 30 best days, whatever. So just missing the best 10 days over a period of almost 10 years, excuse me, not 10 years, a period of 20 years, your return is cut in half. Okay? You're not going to be able to predict when those 10 days are. Okay? So being in the market and staying invested is a key principle. One of the last things I'll mention is taxes. Okay? One of the reasons why I'm in the ETF market, and don't get into the numbers too much, I'm just going to explain this, is how many people at the end of the year got a statement for capital gains distributions for a mutual fund you hold? Many people. ETFs typically skip those taxes. The way they're created, most ETFs do not distribute capital gains. Now, if you buy and sell an ETF yourself in the account, you'll pay your own gain or loss, but you do not get gains or losses from the fund themselves. And so there's an inherent tax advantage in exchange-traded funds. It's one of the reasons why they've grown to $2 trillion in assets. Now, with most of that money coming in the last about 13 years. The last thing I'll mention with ETFs, and then I'll close up here, is all ETFs are not created equal. There's about 2,000 exchange-traded funds that are out there now. I gave a presentation a few months ago at the University of Cincinnati for all their finance department. And I said to these kids, I said, don't walk out of here and send me an email and say, Mr. McClary, I did the great thing, I went out and bought an ETF. The hard part is you do need to work with somebody who knows what's going on and or do your own research to understand what you're investing into. And there's some ETFs, for example, that give you -3 times the market return of what you're trying to buy. That's the way they work. They're tools. Just like you can go to the sporting goods store and buy different types of guns, or you can go to the pharmacy and buy different types of medicines. My wife's a pharmacist, so you don't just hand her son medicine. You make sure he has the right medicine. So be careful, and getting just simply an ETF is not going to be that simple. So that's kind of just, again, I wanted to provide something, just a short update today, and hopefully that was helpful too, just some things to think about. I'm guessing based off the general writings that I've seen that these are topics that are probably you're thinking about right now. And lastly, just thank you for the work that you folks do. And I'm in that stage of my life where I'm really involved in my business and my family and what have you, but I look forward to the days in which I can kind of give back a little bit more and do the stuff that you folks do, because it really does make a big difference. And glad to hear speaking to many of you say you're enjoying what you're doing as well. So thank you for having me, and thank you for the work that you do.
Any questions?
Maybe for some, could you give a basic definition of an ETF and how it's created?
Sure.
The base of it?
Sure. ETFs are very similar to mutual funds. Okay. The biggest difference is when you buy a mutual fund, the way a mutual fund works is you're not actually buying that mutual fund on the exchange like you would buy a stock. What you're technically doing when you buy a mutual fund is you're buying a share directly in that company. So let's say, and you always wait till 4 o'clock. So at 4 o'clock, what the mutual fund company does is they add up all the value underlying holdings. So let's say, for example, the value is 1 share of Coca-Cola at 50 cents and 1 share of GE at 50 cents. The value would be $1, so they sell you a share for $1. So it doesn't matter when you put in the order. You can put the order at noon. You pay $1 at 4 o'clock. So I always describe this like it's going to the mall, buying a suit at noon, go wait around the food court for 4 hours. Like, I can't wait to find what I paid for that suit. Because you're going to get the 4 o'clock price. You don't know what it is, but you're going to get the 4 o'clock price. With an ETF, first of all, they trade like a stock. So your trades execute instantaneously, effectively, and you buy throughout the day. So you have that trading ability. The second piece that's created the tax efficiency of an ETF is that when you buy or sell your shares of an ETF, I might be buying my shares from Jim through the market. So Jim's selling through his broker, and I'm buying through my broker, and we exchange shares on exchange. The ETF in itself is not necessarily creating new shares. We're just trading them back and forth. And with a mutual fund, every time you do that 4 o'clock purchase, they're actually creating new shares for you. So they have to then go unsell underlying holdings or buy underlying holdings to make sure they match up every day, because they're actually issuing and redeeming shares. That's what creates the tax inefficiencies of a mutual fund. And this is a kind of esoteric concept, so it's hard for me to describe in just a minute. But with an ETF, one of the tax advantages comes from the fact that they're not issuing and redeeming shares every day. We're buying from each other. Okay. A couple other quick points is they typically track indexes, and on average, 80 to 85% of indexes beat active managers every year. So that's a statistic. I mean, you can Google that when you go home. And then lastly is fees. Typically, ETFs fees are 15 to 20% of the fee of a typical actively managed mutual fund. So you're saving 75 to 80% fees typically. So more tax efficient, less cost, tracking the stuff that wins 80% of the time. There's a reason why 70% of the net flows in the investment business in the last 3 years have gone to ETFs and indexing. 70%. And they're now $2 trillion. So it's growing significantly. So, well, thank you for your time.
Thank you, that was very interesting. Next, I want to also thank our greeters, Joe Zaptowski and Pete Coheen, thank you very much. And our AV team, Ron Barnhouse, Tom Page, Larry Santon, and Brad Nelson on the camera. Great job, Brad. Don't forget the roast for Jimmy Sutphin is tomorrow at noon. And don't forget to go out and collect your gala gifts. That's very important. Next week, it's going to be April Fool's, so watch out. We have a special program planned for you. And lastly, Rotabuck. Yes. 862. Somebody who arrived after I got here. Nope.
There you go. So it was the one that's on top.
I didn't.
Somebody has to have it. 862.
Okay.
All righty, then we're going to pick somebody else.
All right.
All right.
863. Can't remember that happening.
862, I got it.
Whoa, wait,
Oh, our financial planner.
Too late. That's his pen.
$11. Let's see if you're going to get the jackpot.
We're rooting for you.
Yeah.
Not.
No, sorry about that. We'll see you all next week, except Ron.